today. All right, welcome back to the program. Dr. Hassan Mahmud is joining me right here. He is the Director of Monetary Policy Department at the Central Bank of Nigeria. Good morning to you, Doctor, and welcome to the program.
Morning.
Now, let's get started. From the MPC meeting on Tuesday, can we get a sense that the central bank's MPC have been able to stem the rate of increase of inflation?
Yes, using the first term, I can say largely the monetary policy tightening episodes that we've witnessed has been able to dampen the month-on-month increase in the rate of inflation. Meaning, yes, price levels are still high, but the change in price levels over the period, which is the inflation, has moderated. If you observe the numbers between January last year to maybe middle of last year, July, we had a month-to-month increase in inflation numbers of 100, 120 basis points, 130 basis points. From when the tightening started in the second half of 2022, you start seeing close to the end of the fourth quarter of 2022, you start seeing a month-to-month increase in inflation of 20 basis points. Even the last one, the February numbers is 9 basis points. So you see that decline. Inflation increased between January and February, but the rate of increase between December and January and February reduced, which means there's a dampening effect on that. The argument is always, if nothing had been done, if the rates have been let, it's a hold situation, rates have been let flat, what will have happened? Yes, the inflation numbers, what we saw in these new numbers in terms of inflation is, if you look at the headline inflation increase by like 0.09 basis point, you will see food increased by 0.03, while core declined by close to 20 something basis point. So the push in the headline inflation was largely coming from food. So the effect of what monetary tightening has done impacted more on the core side, other bills and aggregate demand side of it. So you see that if it had not drawn down core substantially, then the increase in inflation we'll have seen in February will be far, far higher than what we have seen. So, in general terms, you can say yes, prices are increasing or prices are still elevated. However, month on month, the rate of increase in the changing in prices is declining. And if you hold on to that and get to a threshold, then you start seeing that, yes, you are bringing down both core and food simultaneously, and then you start seeing inflation numbers coming down. But from what the governor has said and from the revelations we got from the MPC communique, there are still headwinds. There are still factors that are still going to impact on prices. There are new forecasts is showing that the floods is going to come in this year again, even though the bank has, through its intervention, sponsored some dry season farming. So we've been able to, that cyclical shocks that we get from seasonal variations, we've been able to cushion that a bit because you have high volume of productions or agricultural activity taking place in the dry season using this irrigation and other technology channels to do that. So, but if floods also increase in the subsequent period, we start seeing that also slowing down the ability of farmers to produce. We've seen the sensitiveness of food inflation in total headline inflation. So it's important that that side is really curtailed. So those threats of climatic changes, flood, or other pest attacks on farms are likely going to also impact on the level of food production, even though, yes, there are advancements in terms of productivity. We are still using the same smaller sizes of farm to get more output there, but these structural issues still remain. And if that is the case, and then with the banking crisis we are seeing in the US, even though, yes, we said we're a bit, there are mitigants within the Nigerian financial system that is not showing any systemic risk being contagious into the Nigerian economy. but those factors are still playing out. Other geopolitical issues are still there. The Russian-Ukraine is still there. There are other, you saw recently China and Russia, already their presidents are already meeting. We don't know the outcome of that. So there are still tensions here and there, and this will also, those external shocks will also impact on domestic behavior. Don't forget, we have the exchange rate side of all the issues, and this established fact now there's a pass-through from exchange rate to inflation in the domestic economy. So those headwinds are still there. Possibly that prices will go down immediately is still not that very clear. In the United Kingdom, their latest number of inflation increased. They've also been tightening for at least 4 or 5 consecutive times now. But the inflation numbers for February also
but
increased.
their own respond faster than ours.
Yeah, but they started a lot earlier.
Yeah, they started,
than
but
ours.
their own transmission mechanism is more,
yes, more mature,
yes,
and
more
efficient.
effective than ours.
Yeah, that's correct.
Some analysts have also questioned the MPC's rationale as to increasing this interest rate, because that increasing the interest rate may not necessarily bring down inflation if some other variables are not checked.
Yeah, the point is that it may not necessarily bring down inflation 100%, but it will reduce the rate at which prices or inflation numbers go up.
No, that will be slow, because we're seeing the slow rate, and that slow rate,
well,
Nigerians are also suffering it because there's high inflation.
The point is that there's a scope of monetary policy tools, and that scope is to manage the short end of the market and also manage demand. It's a Keynesian monetary policy paradigm. The structural issues cannot be managed or impacted immediately by monetary policy tools. The framework of monetary policies that we adopt now is more or less targeted at, looking at monetary aggregates, which is the behavior in the money markets. So the MPR is supposed to impact on money market rates, and by extension, because that's where banks borrow or do their transaction, by extension, impact on bank rates. So so the activities of the central bank or monetary authorities is within that banking and financial system. All other issues related, we mentioned food, that food prices went up. Major factor that drove increase in food prices were more logistics. Cost of transporting foods from the rural areas or farms to the urban area, cost of storage of foods, or particularly perishable food items or the fisheries or stuff like that. You need to have a cooling house, you need to buy diesel to run the gen, to have the coolers running, you need diesel for trailers to carry. So those costs built into it by the time they get to the market. And when they take this off, you now get the numbers rising in those areas. So the logistics was a major contributor to that cost of, you know what happened with PMS, both the scarcity and the increase in the price, even though we don't have full liberalization there. So you see that playing out substantially. Ability for some farmers to also hold their products for longer than maybe a week or two. So people doing plantain, tomatoes, unless you have cooling system or where you can preserve those items. If 2-3 days they are not sold, they are gone. So the ones that are in the urban sector, because they are few and there's a high demand for them, you see the prices going up. The monetary policy tools were one to tame what we call the pent-up demand, because we had so much injections that came in post-COVID, so a lot of monies were there, but the production was not meeting up with that volume of demand. So we needed to tame that so that production can have time to pick up. And that was what the tool is. So 100% monetary policy tool will not be able to bring down inflation immediately, but it must be complemented by some improvement in some of the structural factors that we've mentioned that are impacting on inflation. And that is going on.
What's coming to my mind now is how much of a trade-off are we seeing between monetary policy and financial stability? Or how much of a trade-off did we see between monetary policy and financial stability at this MPC meeting? Bearing in mind that we've seen in advanced economies like the US and even Switzerland, the US especially, just earlier on we did take Janet Yellen, who is the Treasury Secretary, that's the Finance Minister of the US, talking about failed banks. Yeah. So how much of a trade-off was the MPC really on in terms of monetary policy, while we're also still having one eye on financial stability? Or financial stability did not matter and you went on full on monetary policy?
I think the dilemma always has been trade-off between monetary policy
And
objective
growth.
prices and growth.
But this
Now,
time,
this time around,
it was
it
not
was
it.
largely around, yes, you are tightening. We are aware that conditions are already tight in the banking system. We see the signals for that from the rates, the treasury bill rates, the OBB rates that are within the markets. We see those ones going up. Don't forget that those rates were, very, very low, sometimes less than 1%. We see that going to 9, 10%, and even above 10% now. That means liquidity conditions in the banking system is tight. This will likely affect the rate of growth or expansion of credit, which is what we need to drive growth. Now, when we saw what happened in advanced economies in terms of the bank failures, the question is now, how exposed are your banks? How resilient are the soundness indicators of your bank to these external shocks? So the assessment by monetary policy members was the fact that if you tighten further, what implication will it have for financial system stability? How will it, because if you look at what happened in the SVB, it was largely, maturity mismatch, in the sense that when some of the instruments they are holding were marked to market, losses were, declared immediately. Otherwise, they had short-term funds that came in and invested in long-term instruments. And because rates were going up in the US, at mark-to-market, those facilities were loose because you buy them where they are cheaper. Now, the yields on them was so that was what really impacted on that bank very quickly. So on the Nigerian side, it was important for the members to look at what is the state of your financial system, particularly the banking institutions. How resilient are they? How robust are the parameters we look at? Capital adequacy ratio, liquidity ratio, their earnings, to be able to withstand this. So the members saw that yes, there's a room, for some buffer condition where even if you go higher, albeit moderately, we'll be able to solve the inflation problem and still keeps the banks, going concern. So I think the balancing act was really deployed, and like you said, it was important that because the trade-off for the financial system stability against monetary price stability it is very disastrous, because the channel for implementing monetary policy is actually the financial system. So if that system collapses, then the pass-through of monetary policies is just not going to be there.
Okay, just as we round up, because we have just a minute to get out of here. So from this meeting, can Nigerians really take it that the MPC is on a full-on anti-inflationary path this year?
Well, it depends on how the numbers come out. But I think Governor also said it at the press briefing, that so long as these conditions and these headwinds remain, monetary policy stance will still be in the tightening mode. If those conditions change dramatically, and economic conditions, the frequency of change now is very high, and it could be big. We saw a bank that went under in a day, and these are banks that are there for decades. So economic conditions change very swiftly. If those conditions change very swiftly, then monetary policy will also react, the same swift manner. But for now, and given the forecast and outlook for the rest of the period, these uncertainties and shocks are still there, and monetary policy needs to be more focused on price stability. And for as long as our inflation numbers are way above 20, at above 20%, as against single digits of 6 to 9%, then definitely monetary policy should keep, holding on this policy stance to at least bring inflation to a bearable minimum.
Okay, thank you very much, Dr. Mahmud. All right, I've been speaking with Dr. Hassan Mahmud, who is the Director Monetary Policy Department at the Central Bank of Nigeria. That's the much we can take today. Thank you for your company as always. Please join us again next time. I am Nancy Naji. Be the best you can be, and be the change that you want to see. Bye now.